Hey everybody, Dr. Phil here. This is going to be a video on accounting for receivables. Let's go ahead and jump right into it. So the first thing we're going to talk about is valuing accounts receivable. So what is a receivable? A receivable is something you are going to receive from another party, hence the name accounts receivable. You're going to receive it in the future. So you can see here some companies and how the receivables comprise their total assets. So like Nike, 18%. Microsoft 10.3, so on and so forth. Now, every firm, every company has to maintain a separate account for each customer that tracks how much that customer purchases, has already paid, and still owes. So it's not like you just have you got accounts receivable, right? But you've got to know like of that total amount, who owes you what. So credit sales, journal entries. So let's take a look at an example of a journal entry for a credit sale. So on July 1, Techcom had a credit sale of 950 to CompStore and a collection of 720 from RDA Electronics from a previous credit sale. So the first entry we see here, we have a debit, an increase to accounts receivable for 950, and of course a credit increase to sales. So it's just recording, okay, we made a sale, we've got accounts receivable, we haven't got the money yet, but we'll get it in the future. And then we are recording the second transaction where we actually have now received the money from somebody else. Debit to cash, increase in cash, and a credit to accounts receivable for the amount of 720. So cash is going up. The accounts receivable is in the second entry. RDA Electronics is being removed because we've now collected that money. So if we look at the accounts receivable ledger, then these are just the two journal entries at the top here. You can see where these amounts are being added, right? So you can see we've got you can see the 720 here that was credited. You can see the 950 also. So if we were looking at the ledger for accounts receivable, and it would also tell us like if we really wanted to know like okay who owes us that 950 and who just paid us that 720. All right, sales on bank credit cards. So on July 15th, Techcom has $100 of credit card sales with a 4% fee, and its $96 cash is received immediately on deposit. So we have this debit to cash, this increase to cash for 96. We have an increase to credit card expense for 4, and then we also have an increase to sales of 100. So we're basically just recording the sales, what we got to pay the credit card company for, $4, and then what we're actually going to keep in terms of cash, 96. Okay, bad debts. So some customers may not pay their accounts. It does happen. Uncollectible amounts are referred to as bad debts. So there's two ways we can take care of these. We can use what's called the direct write-off method, or we can use what's called the allowance method. So let's talk about the direct write-off method. So recording and writing off bad debts. So TechCom determines on January 23rd that it cannot collect 520 owed to it by its customer J Kent. So what they're going to do is they're just going to record, okay, we're not going to get this 520, so we're going to go ahead and debit or increase bad debts expense. And then they are going to credit or decrease the accounts receivable for this individual, J Kent. Why? Because we're not going to get it right. May as well remove it. And it says, notice that the specific customer is noted in the transaction, so we can make the proper entry in the customer's accounts receivable subsidiary ledger. Now, what about recovering a bad debt? So let's say that this is usually in the future. Maybe they call you and say, "Hey, I'm sorry I flaked out on you. I'd like to take care of that debt." Usually because they want to start doing business with you again. So it says on March the 11th, J Kent was able to make full payment to Techcom for the amount previously written off. So you can see we have the debit to accounts receivable J Kent. We're increasing that. We are removing the bad debt expense. If you go back and look at the last journal entry, in fact, let me just go back. Look at what we have here. Debit 520 to bad debts expense, credits to the accounts receivable. If you look at the first entry here, it's just the reverse. We're just switching it because we're just reinstating that accounts receivable that we had removed. Once it's been reinstated, we can just immediately then take care of it. So we're going to debit or increase cash for 520, and we're going to credit or credit or decrease accounts receivable to recognize that we got paid. Okay, using the direct write-off method, expense recognition principle requires expenses to be recorded in the same accounting period as the sales they help produce. We usually call it the matching principle. Materiality constraint permits direct write-off method if results approximate results using the allowance method. Um, the direct write-off method usually does not best match sales and expenses, which is why, to be honest, no one really ever uses this. Most companies use the allowance method. So let's talk a little more about the allowance method. So at the end of each period, we're going to estimate, and again, it's an estimate, right? We don't know for sure yet. We'd love nobody to flake out, right? But the reality is companies will flake out. So at the end of each period, we're going to estimate the total bad debts expected to be realized from that period's sales. So there's two advantages to the allowance method. The first one is it records estimated bad debts expense in the period when the related sales are recorded. So we're doing a better job of the matching principle. And number two, it reports accounts receivable on the balance sheet at the estimated amount of cash to be collected. So that maybe speaks to the conservatism principle in accounting. So let's talk about recording a bad debt expense under the allowance method. So it says TechCom had credit sales of 300,000 during its first year of operations. At the end of the first year, 20,000 of credit sales remained uncollected. Based on the experience of similar businesses, TechCom estimated that 1,500 of its accounts receivable would be uncollectible. So they're going to go ahead and debit bad debts expense, kind of like we did before. What they're going to do here is they're not going to credit accounts receivable directly because we actually don't know yet if that person's going to, if anybody's going to flake. So we're gonna record it to an account called, think about the name allowance for doubtful accounts. Okay, 1,500. So you can see in the T accounts down here, we've got the debit to accounts receivable for 20,000, and we've got that was the beginning balance, and then we've got an allowance for doubtful accounts. We've just basically added 1,500, not because anybody has flaked out yet, to take care of any flake. I use the word flake outs, but that's best word for it. To take care of any potential flake outs in the future. So here you can see we've got accounts receivable of 20,000 less the allowance for doubtful accounts 1,500. So we've got 18,500. So what we're really saying here is, okay, if you're presenting this on your financial statements, hey guys, we should get 20,000. Based on past experience, we'll probably won't get 1,500 of it. So we're more likely going to get 18,500. Be great if we got the whole 20. It's probably unlikely. All right, writing off a bad debt. So TechCom has determined that JKent's 520 account is uncollectible. So what they're going to do now is they're going to, because remember we already did the expense. We already expensed that 1,500. So we're going to debit an allowance for doubtful accounts. So you can see it over here in the red. And we're going to credit accounts receivable. So we're basically removing the account receivable, right? We're lowering that 520 because we're not going to get that. And then we're basically, you could think of it as using for the allowance for doubtful accounts. We're basically using up of the 1,500 that we allocated. We're kind of using up 520 of it. Now, the write-off does not affect the realizable value of accounts receivable because if you remember, um, we already we'd already kind of lowered it to 18,500. So if you look at how this changed before, it was 20,000 AR accounts receivable, 1,500 allowance. Now it's 19,480, but the allowance has been reduced to 980 because we just used up 520. So in either case, it's still 18,500. So what about recovering a bad debt? To help restore credit standing, a customer sometimes pays all or part of the amount owed on an account, even after it's been written off. So it says on March the 11th, Kent pays in full his $520 account previously written off. So again, the first thing we'll do is reinstate the accounts receivable. That's what we're doing here. We're debiting or increasing accounts receivable. And then we are crediting allowance for doubtful accounts. We're basically taking that 520 that we had sort of used up and we're just moving it back over to the allowance side, to the credit side. And then we have a debit to cash, we're increasing cash, and a credit to accounts receivable, again, to recognize that this has now been paid. All right, so you might say, well, how do you figure out what the bad debt expense should be? Like for the estimate, like I get it's an estimate, but how do you know how much it should be? So there's really two ways to do that. We can use the percent of sales method, or that's more of an income statement method, or we can use a balance sheet method, which kind of revolves around accounts receivable. We can use percent of accounts receivable, or if you want to do something more weighted, we can use an aging of accounts receivable. So if we're using the percent of sales method, which is very simple, we'll just compute bad debt expense by taking our current period sales and then multiplying it by whatever our bad debt percentage is. That's going to give us our estimated bad debts expense. So as an example, you'll see how this one's really easy. Musicland has credit sales of 400 grand in 2021. It's estimated that 0.6% of credit sales will eventually prove uncollectible. So let's look at recording bad debt for 2021. So as you can see, we're just taking the 400,000 times zero point 0.6. Be careful putting that in a calculator. Make sure you put um, 0.006 to get the right number. And then you'll get the 2,400. And that's it. That's all you do. And then we're going to debit bad debts expense, credit the allowance in the amount of 2,400. Now for the percent of receivables method, um, so the first thing we'll do is, you can see down here, we're going to estimate bad debts expense. We're going to figure out what that is, which we'll get to in a second. But then we're going to look at, okay, do we have a previous balance in the allowance account? And then if we do, we're going to offset that, and then that will give us our current bad debts expense. So by way of example, so it says Musicland has 50,000 in accounts receivable and a $200 credit balance in the allowance for doubtful accounts. 5% of receivables are uncollectible. So if we take the 50,000 times 5%, we got 2,500. So we need 2,500 in there, but remember, there's already 200 in there. So what we're going to do is we're going to say, okay, well, see where it says unadjusted balance 200. We've got to think of it, we've got to get it from not from 0 to 25, but from 200 to 25. So thus we need to make an adjustment of 2,300. And then the journal entry to record that, we would have a debit, an increase to bad debts expense, and a credit to the allowance for doubtful accounts. I'll just call it the ADA in the amount of 2,300. So what about the aging of receivables method? So the first thing we'll do is classify each receivable by how long it's past due. Obviously, we all know there's a relationship between how long it takes to pay something and whether it gets paid. If you don't believe me, go lend somebody some money. You'll find that out real quick. Each age group is multiplied by its estimated bad debts percentage, which increases as the older it gets. And then estimated bad debts for each group are totaled. So this is kind of what they're doing here. If you see, we've got these various amounts, total receivables. So if we look at like not yet due, 37 grand, and then look at these percentages, you see how they're increasing, as they should be, because the older it gets, the less likely you're going to collect it. So the percent uncollectible increases. And then they're just basically doing that for each category. So like, for example, 31, 60 days, 3,700 times 10%, 370. And then, 61 to 90, 1,900 times 25%, 475. And then we're just adding those all together to get our estimated uncollectible of 2,270. If we have an adjusting entry, excuse me, with a credit balance, again, let's say that the unadjusted balance is 200, then the estimated balance is 2,270. Again, I'll go back. That's where I'm pulling that 2,270. Then we would just need the difference. So we would record a debit to bad debts expense and a credit to the allowance for 2070 again to get from not from 0 to 2270, from 200 to 2270. All right, let's talk about notes receivable. So a promissory note is a written promise to pay a specified amount of money, usually with interest, not always, but most times, either on demand or at a stated future date. So you can see we've got the amounts, we've got the date, we've got how long the note's for, 90 days or 3 months. We've got the name of the company, and then of course we'll put the interest rate. So that's pretty steep interest rate, but that's the direction it's moving, so it's probably appropriate. So the maturity date of a note is the date the note and like the principal and the interest must be repaid. So if you ever hear that term, maturity date, that's what they're talking about. So it says on July 10, TechCom received a $1,000 90-day 12% promissory note as a result of a sale to Julia Brown. So what we're doing down here is we're just basically saying, okay, let's figure out what is 90 days from now. So July 10th, right? We just add up all the days and then we end up at October the 8th. So the maturity date, the date the interest and principal are due, is October the 8th. The interest computation is always this. You can take this to the bank, no pun intended. It's always the principal of the note. Think about the amount borrowed times the annual interest rate multiplied by the time expressed in fraction of a year. That's going to give you the interest. So as an example down here, 1,000 times 12%. Just be careful putting that in a calculator, times 90 over 360. You could always decimalize that, or you can just think about your order of operations. And then you can simplify it like I did here. 1,000 times 0.12 times 0.25. So the interest is based on $1,000 principal. Based on 90 days or 3 months, the interest is $30. Because remember, interest is always expressed as a percentage for a year. All right. So what about recording notes receivable? So notes receivable are usually recorded in a single notes receivable account to keep the record keeping simple, theoretically. The original notes are kept on file, including information on the maker, rate of interest, and the due date. So to illustrate the recording for the receipt of a note, we use the 1,000 90-day 12% promissory note from Julia Brown to TechCom. So TechCom received this note at the time of a product sale to Julia Brown. So you can see the debit to notes receivable. That's increasing the asset account notes receivable. And then we have an increase of the equity account sales. Now, the reason there's no interest there, because I always get asked this from students, is this is the first day of the note. This is like day zero. So there's no interest hasn't had the time to accrue yet. You'll see that as of like the next day, day one. So a seller may accept a note receivable from an account receivable customer to allow an extension to pay a past due accounts receivable. So maybe it's been sitting in accounts receivable for 2 months. They call you and say, "Hey, I can't pay this," and you say, "Okay, well, I'm willing to let it continue, but now it's going to be a note receivable because I'm going to charge you interest." So to illustrate, assume TechCom agreed to accept 232 in cash, along with a 600 60-day 15% note from Joe Cook to settle her 832 past due account. And this is what they're recording in the transaction, in the journal entry here, right? A debit to cash for 232, a debit to notes receivable to increase that, and then a credit to accounts receivable. So they're basically removing the accounts receivable with the credit. They're increasing cash by 232 because they're getting that now. And then they're also recording the increase to notes receivable. So recording an honored note, that just means that an honored just means somebody paid it when they were supposed to. That's it. So the principal and interest of a note, of course, are due on its maturity date. So J. Cook has a 600 15% 60-day note receivable that's due on December the 4th, so it's been paid. So the company is increasing cash for 615. That, of course, is the principal and the interest. They are removing notes receivable because it's now been paid. So that's an asset account, so it's a credit to remove it. And then they are recording $15 worth of interest revenue. So what if it's not? What if it's what we call dishonored? So the act of dishonoring a note does not relieve the maker of the obligation to repay the principal and interest due. So again, same scenario. So what they do now is, if you notice, they're just transferring it all to an accounts receivable. They've taken the original note, 600, they've taken the interest that they should have gotten, 15, added them together, and they've just now created an accounts receivable. So that person isn't getting out of it just because they didn't pay it. Okay, recording end of period interest, an adjustment. So this is as of the last day of December. So it says on December 16th, TechCom accepts a 3,000 60-day 12% note from a customer in granting an extension on a past due account. When TechCom's accounting period ends on December 31st, 15 of interest has accrued on the note. So we're just making sure that again, it really speaks to the matching principle. And we're just making sure we record this $15 of interest. Again, the 3,000 times 12% times 15 over 360. We're just making sure it's been recorded in the correct period. Now, they're not getting the interest yet, so what we're going to do, or what they're going to do, is they're going to record a debit to interest receivable. That's an asset account, increase with a debit. And they're going to go ahead and record a credit increase to interest revenue. This is where you can see it here. So you've got if you look at the journal entry down here, once they collect it, they're going to get cash of 3,060. They've got interest revenue that they're recording in the next year of 45. They're removing the interest receivable. This is from last year because they've now got the money, right? And then they are removing the note receivable.